Greetings class and welcome back. This is chapter 6, variable costing and segment reporting, and we're going to look at the beginning of the chapter in this lecture video. We're really looking at variable and absorption costing. So what we're looking at in this particular video is variable versus absorption costing. Alright, so when we talk about variable costing and the way it differs from what we've been doing, we're going to look at these three assumptions over here. What we were doing in job order costing was this idea of normal costing. What we're going to do here with variable costing is what we call actual costing, and that will include using the actual number of units to allocate as an allocation base for the actual fixed overhead. All right, that's a big difference. Okay, we were looking at projecting an estimated number of allocation units and then assigning the overhead based on that. So in this particular chapter, the assumption is we're using actual costing rather than normal costing, like they did in job order, and that includes this idea of actual number of units produced, which is the driving allocation base for assigning actual fixed manufacturing overhead cost. So whatever we do, one of the key components in this is going to be we're going to separate out variable manufacturing overhead, and that's going to be very straightforward because it'll be on a per unit basis. But then we're going to have a fixed manufacturing overhead. And the thing is, when we're doing the allocation of overhead, when we're identifying where it belongs, we'll want to take this fixed manufacturing overhead and convert it to a per unit basis. And the way we're going to do that is we're going to divide the cost, the fixed manufacturing overhead cost, by the units produced. So that's an important distinction. Now this chapter always assumes a variable cost per unit is going to be constant. So when we're talking about that, you're talking about the variable cost curve, which really is going to be a slope. So the costs remain constant in this way. Okay. So when we're talking about, doggone it. So when we're talking about remaining constant, we mean a variable cost per unit will be consistent. All right. It won't change in the range. The variable cost per unit will remain consistent, which will produce an angle curve like this, or a slope. The fixed cost in total will remain constant. So when the fixed cost in total is constant, you just basically have this straight line across. Kind of looks like a slope. It's not very good, but you get the idea. It's a straight line. This is a slope going up. The more we produce, the higher the cost. Here it should be more like a flat line because it's never going to change, right? The volume won't change the total cost. So let's take a look at the overview of the differences we see between the two. First of all, let's look at variable costing. When we think of variable costing, we're going to include in variable costing the difference is what we include in product costs, all right? So when we do variable costing, we're going to have direct materials, direct labor, and variable manufacturing overhead. Those are product costs, all right? Now and I'll explain this when we get to the actual income statement using variable costing. because in a variable costing method, we're going to use the contribution approach, which will also include all of the variable costs coming out before you get to contribution margin. But not all variable costs are product costs. These are product costs. They always will be in variable costing. So that's the only cost we're going to consider as product cost. Period costs in variable costing, which are not included in, and you might think of this in another way. Think of this as inventory cost, all right? This is the cost that's going into inventory, all right? Period costs, on the other hand, are going to be the fixed overhead and then any kind of sales and admin cost, and that includes both fixed and variable, all right? So when we look at sales and admin, we're talking about both variable and fixed. We don't really care. They're all always going to be period cost. Selling and admin costs are never product cost. All right, so that's the variable costing approach. Now for the absorption costing approach, what we're going to do here is we're going to include fixed manufacturing overhead in product costs. So when we do product costs here, we're going to include the things we did with variable costing, which are direct materials, direct labor, variable manufacturing overhead, and we're going to include fixed manufacturing overhead. What that means is the product cost here will we'll actually put part of the fixed manufacturing overhead cost into the inventory. So these are inventory costs. So that I want to point out something here, okay? There's going to be a difference in the value of inventory between these two methods. Here, the only thing going into inventory costs are the variable product costs, direct materials, direct labor, variable overhead. Down here, product costs will include those direct material, direct labor, variable overhead, but also fixed manufacturing overhead. So, just to explain the difference here, in a year where your production is equal to sales, both methods will produce the same result for net income. So if production equals sales, variable and absorption will give you the same net income. Okay, that's important. This is an important point, and it will be on the exam. All right, now if, on the other hand, production is greater than sales, so if you produce more than you're able to sell, then the absorption approach will give you a higher net income. So we have a higher net income with absorption in this circumstance. Now, that means that you're producing more than you're selling. Now, I like to compare this to this idea. Now, every time I go by a car lot, I think of this. But if you look out at these large vehicle dealers and these large car lots that they have, back when I was younger, they didn't have car lots that were this big, but now they have these enormous dealerships where they have hundreds of cars out on the lot. And it makes you wonder, makes you think about, okay, they're producing a lot more product than what they're selling at the time. Well, the only way that works out in the short term that works out well for the producer, because if they're doing absorption costing, that means that more of the costs are going into inventory and they can show a higher net income in the interim. Now, you might think about this related to taxation. If you're thinking just about taxes, this is not a good idea. However, some publicly traded companies are interested in showing strong net income numbers so they attract investors. Now, the other thing to think about is if production is less than sales. Oh, come on. So if production is less than sales, variable costing will give you a higher net income. All right? And it's because because you're not putting as much cost in inventory here, that you're selling more of what you have in inventory. So you're going to have a higher net income. Now, a company may strategize for a lot of different reasons. Like I said, a company may want to present strong net income numbers to the investors. And if you're in production and your market is soft, using absorption costing can present a stronger net income to your investors. However, you may not want that. You may want to avoid the taxes, and if you are in that situation, you may want to go to a variable costing approach, where if production is greater than sales, you wind up with a lower net income. But the thing to remember is that these are cyclical, that they do not always, it does not consistently stay the same all the time. So it's possible for this to reverse itself in subsequent years. All right, because that's dependent on how many units you're selling. So now let's take a look at this slide here where we talk about the unit cost comparisons. All right. When we talk about unit cost comparisons, here they produce a single product with the following information. They have the variable cost per unit that include $10 for direct materials, labor, and variable overhead. Selling and admin expenses that are variable are $3. They have manufacturing overhead of $150 and selling and admin expenses of $100. Okay. Now, what we want to do is under the absorption method, and they don't show this here. Well, yes, they do. They're right here. So they're producing 25,000 units, okay? So when we go down to calculate the cost, the unit cost for product, we're going to take the $10 as a base for both, all right? The $10 product cost is always going to be there for variable. For absorption, we're going to take the $150,000 in fixed overhead. So we take fixed overhead of 150,000 divided by 25,000 units. Okay, giving us a cost per unit of $6. That's how we wind up here. Okay? All right. Sorry, I sort of paused things there for a moment. All right. Now, here's another assumption. Let's assume the following additional information for Harvey. 20,000 units were sold during the year at a price of $30 each. All right? There is no beginning inventory. Now we're going to do net income using both approaches. And I want to show you this difference. So we start here with sales, 20,000 units at $30. We get $600,000 in sales. The variable cost of goods sold because we're using that $10 cost for product cost. Since this is variable costing, is $200,000. Using a contribution margin approach. Now, this variable selling and admin is not product cost, but it is variable cost. So in a contribution approach, we take that out. We have a total then of $260,000 in variable costs. So our contribution margin is $340,000. We deduct fixed overhead here, fixed selling here, and that winds up being $250,000. So we have a $50,000 or $90,000 net income. Okay. Now let's suppose we do something the same thing, only we're using absorption costing. So with absorption costing, we have the same same sales number. Sorry about that. We have cost of goods sold, which is going to be the $16 per unit we figured for absorption costing, times 20,000 units. The gross margin is here. Now, the difference is that the fixed overhead is buried in this. We're not going to deduct it down here in the selling and admin costs. So in selling and admin, we take the variable costs, 20,000 units at $3, and a fixed cost of 100,000. We wind up with $120,000 as net income. The reason you see that difference is because the production exceeds sales. So if production is greater than sales, absorption will give you a higher net income. All right, that's an important point. Now let's take a look down here at this next slide and where we compare the two methods. Now if we think about this, under absorption costing, we have the $200,000 of variable manufacturing expenses and the fixed expenses that go into inventory. They become a part of cost of goods sold. Remember, we actually had $150,000 in fixed manufacturing overhead, right? What they're showing you here is that using absorption, you only charge what you sell against net income, which means of this 150, you only recognize 120 in the current period. All right? That's an important point, because the 30,000 of this cost of fixed overhead is going into ending inventory. It's not going into cost of goods sold. So when you say you have 150,000 fixed overhead, absorption charges 120,000 against current cost of goods sold. The balance of 30,000 is an asset in inventory, and you don't charge it against income. Okay? That's the big difference. If we're looking at variable costing, we're not even going to deal with this as a part of the product cost. We're going to put it over here as period cost. So no matter what, it gets charged against income, right? So in variable, you always charge all fixed overhead against income. All fixed overhead is deducted from income. So that's a big difference, all right? So that's a big difference that we need to recognize. All right, then, so when you're thinking about this, we're thinking about reconciling the difference between the two. This is how we would do it. You have the variable costing net income, which is 90,000. We're adding this, what we would call deferred cost in inventory for the 5,000 units we didn't sell at $6 a unit of 30,000 to arrive at the net income absorption costing gave us. Okay, so that's an intro into variable and absorption costing. I hope you find this helpful. There will be another video coming out shortly.